Hi, my name is Fulton Abraham Sanchez. I am the CPA of the firm FATCA Consultants, and today we are going to speak about U.S. expat reporting obligation for foreign bank accounts. There is a reporting obligation for the U.S. Treasury known as the FBAR report. The FBAR report is composed of two main elements. The first one is the requirement for any account, foreign bank account over $10,000 needs to be reported to the U.S. Treasury. This requirement is not only for if you have one account with $10,000 as a balance, but also if you have several accounts making up a balance of $10,000, even though they individually they do not represent $10,000 each. If in addition of those accounts they make up $10,000, you are obligated to report the 4, 5, 6 accounts that make up that balance. The second part of the FBAR is the penalty. Usually, or in the past, it was believed that the penalty was $10,000 per year, independent of the number of accounts that were not reported. We have another video with a case where the courts give the reason to the U.S. Treasury, stating that the penalty was not anymore per year, but actually a penalty per account. In that particular case, the taxpayer ended up with a penalty of $130,000, meaning 13 accounts times $10,000. So the U.S. Treasury assessed a penalty of $10,000 for each one of the accounts making up $130,000. So be very careful when you are doing your FBAR reporting and considering excluding some of the accounts or some account, because that will create, even though you report correctly and on time the FBAR report to the U.S. Treasury, that will create a penalty of $10,000 for one of the accounts or the number of accounts that you will meet if you do not report. In terms of tax principle, the foreign bank account reporting is the famous FBAR. This particular legislation or act was created with the objective of measuring the increase in the balance of the foreign accounts that taxpayers, U.S. taxpayers, hold in foreign jurisdictions. This could be offshore jurisdiction or any jurisdiction that, for example, a U.S. expat reside. In that case, the objective of the FBAR is to match the increase in the account that any taxpayer will have. For example, if you have a trading account, a foreign trading account, if you have a foreign bank account and you receive income, for example, dividends, you receive capital gains, you receive interest in because of the dealings of those accounts, you are supposed to report those monies as an income in your income tax return. So the objective of this legislation is precisely measure year to year when you report the balances to the U.S. Treasury to do the match between that increase of the balances of your foreign bank accounts with the amount that you report as income in your income tax return. In addition to the FBAR and the requirement to report any account over $10,000 or any account that make up $10,000, there's also the Foreign Account Compliance Act, also known as FATCA. FATCA is another part of the legislation dealing with the foreign accounts, but this is different amount. You have to report FATCA when the balance of the foreign account is over $50,000, and you report this to the IRS. Now, if you're an expat, the balance actually is increased to $200,000 if you are single, and $400,000 if you report married filing jointly. There is also the Foreign Earned Income Credit. The Foreign Income Credit, or FEIE, is a particular credit created for any expat living outside of the U.S. and working in that country and receiving income, but this income must be paid as a salary and contributing to the Social Security Administration of the country. Any income that is not salary income and is not contributed to the Social Security Administration of the country is not considered foreign earned income credit, foreign earned income, and therefore it will not be applicable within the foreign earned income credit. Depending on the year, the foreign earned income credit is between $100,000 and $110,000. So if you are an expat and you receive income in the foreign country, and that income is pension security to the administration in that country, then you will be able to take this foreign earned income credit. But any income that is not within the salary income will not be included. So any contracted income, any self-employed income, any dividend, any interest, even rental income that you receive in the country that you reside outside of the US will not be included in this particular foreign earned income credit. In addition to that, if your salary income is beyond the credit of the foreign income credit, let's say it's $110,000. If you make $150,000, the difference between 110 and 150 will be taxable at the current level of that income. So it will not be, the portion between 110 and 150 will not be taxable at 10% or 15%. It will be taxable perhaps 25% at the regular tax rate of that income level. There is also, in addition to that, the worldwide income taxation. In the USA, you are subject, if you are a US citizen, you are subject to taxation over the entire amount of your income, regardless of the country or origin of that income. So, for example, if you reside in the USA or you receive income from a foreign source, you are supposed to include that income within your income tax return and pay taxes on that, even though that income has not been created in the United States. In addition to that, after the recent tax reform, any income that you have in a foreign company, regardless if you receive the distribution of that company, and obviously you own the company over 10%, you own the company, and even either you receive the profits of the company in terms of dividend, or you do not receive the profits, you are supposed to report that in your income tax return and pay taxes. This is a change from the previous legislation. You were supposed to only report that income and pay taxes when you bring the profits of the company or the foreign company here to the US in terms of dividends, but not anymore. Now you have to pay taxes on that. There is also the belief that even though you do not receive a W-2 or 1099 to the IRS, you are not supposed to pay taxes on the income that you make outside of the US, and that is not true. As the application of the worldwide income taxation, if you make or you earn money outside of the US, this is for dividends, this is for interest, this is for contracted income, and even though you pay taxes in the country where you make that income, you are supposed to include again that income and report that to the IRS and take a credit for the taxes that you pay in the country where you reside, but still you need to report and pay taxes on that. I've seen many times people believe that because they reside in a different country, they don't have any obligation with the IRS. That is far from the truth. You are supposed to report your income, take a credit for the taxes that you pay in that country or that you reside, and then report that income to the USA to the IRS, and then you take a foreign tax credit for the income that you paid, for the tax that you paid in the foreign country. You take that as a credit and you report to the IRS. But that is the obligation as a US citizen if you live as an expat in a foreign country. In terms of reporting, the FBAR, you report it to the US Treasury. In addition to that, FATCA, you also report that back to the IRS. The two reports are an obligation deadline April 15. If you have filed an extension for the FATCA, October 15. Because remember, this is with your income tax return. For the FBAR, you don't need to file any extension. There's automatic extension for October 15. Now, if you have any question or you want to see more videos about these topics, you can check the reproduction list in here in our YouTube channel. If you have, you can also subscribe to receive updates when we post more videos. And if you have any specific question, Check the link here in the box description of this video and send us an email, FACPM Consultant. Thank you.